Hey everybody, my name is Adam Block. I wanted to put together a quick video talking about corporate bond basics for individual investors when AMC can be a better deal than Apple. Just a quick disclaimer, this video is not investment advice, it's not legal advice, and the things I'm saying are based on my own opinion, so you can't rely on any of this for representation of fact. And then a quick commercial, just want to let you know that I am a partner in the MVP long short strategy. We try to earn better investment returns in stock portfolios by owning good assets, shorting bad stocks, and reinvesting gains to own more good assets over time. If you have any questions, you can email me at adam@mvplongshort.com. So to get started, one of the places I look for information about bonds is on this site by FINRA, run with Morningstar. Okay, so I'm going to start here, go to the search area, and then for the example today, I picked Apple, the first example. It's a company we all know. Okay, show results, and there's some other things you can do to search in that functionality. Okay, I'm going to sort these by maturity, and I'll explain all of this in just a second. Okay, and then I'm going to look for, let's find this 2023 maturity. Okay, right here. That's selling for a little bit less than 100 cents on the dollar. And see what we get. Okay, this is how they display it, and you can see the borrower's Apple. The maturity date is May 11th, 2023. Okay, the coupon rate is the amount of interest you get paid by the company, and it's 0.75%. So for a bond of $1,000, you'll get if you got paid 1% interest rate, that would be $10. So if you owned $1,000 bond here, then you'd get paid $7.50. Okay, so then a couple other things that are going to make a big difference. All right, the last trade price for this was 99.25. Okay, so for $1,000 bond, you're going to pay $990. And I'm sorry, $992.50. Multiply that to get to 1,000. Okay, and then in a second we'll talk about the yield on that. So here, the coupon of the bond that they're going to pay you is only 0.75%, but the interest rate, okay, that needs to be achieved to get people in the market to go buy that bond is 1.394. All right, and you can see that the price of the bond has gone from 101. Okay, so a little bit more than the premium you paid, a little bit more than the amount you were going to get back, and accepted a low interest rate, and it's fallen in the last year to 99.27. Okay, that's a function of broader interest rates. So you can always look up, Treasury bond interest rates, okay, or the yield curve, and you'll see this get reported, all kinds of places. CNBC is just as good as any because you'll see, um, information about stocks there also. Okay, so this is a bond due in 10 years should pay you 1.77% per year. And uh, our bond is not going to go out quite that far, but we can see over the last year that that 10-year treasury, okay, was yielding 1.27% in July, and it's up to 1.77 here. So the same story, even though this is a 10-year chart and we're dealing with a 2-year bond, apply over here. The yield you got used to be lower, which means that the price you paid used to be higher. Okay, and now that interest rates are rising, the price of the bond fell, and meaning the yield goes up. That's how bonds get quoted. Okay, so what do you get when you um, buy an Apple bond? I'm looking up here information on the SEC website about Apple and what the company does. There are a lot of sites that give you information about the financial condition, and you can also go to the company itself. I really like going to the SEC website and looking these things up because you get the same information in the same format. Nobody's interpreted or changed it. And there's all kinds of things that you're not going to know until you look it up the right way on your own. Okay, so now we have the company's annual report reported to the SEC. For most bonds, you want to look at the financial statements. Okay, and so to find that, I just think this is fastest. Control F, Okay, and then one of the first terms that appears on the balance sheet of a company is what I'll search for here, cash and cash equivalents. Okay, so I'm going to shrink the screen so we can see a little better, maybe see the whole thing at once. All right, so the first cash flow statement here is the balance sheet, and we see that Apple has $35 billion worth of cash. And then they have securities worth 28 billion. I noticed that I think they actually have filed a quarterly report since then. And so normally we could go to the quarterly report that'd be more recent, but this will be fine, for a broad discussion. Okay. So current assets are assets they can get their hands on or use up within a year, and that's 135 billion. Then their non-current assets are things that should be good for more than a year. So you see there's 128 billion of marketable securities, okay? Equipment, about 40 billion. Other assets, so that could be like their intellectual property, they value on the balance sheet at about 50 billion. So this is an issue in thinking about balance sheets. Clearly, it would cost a lot more than 50 billion to replace the intellectual property of Apple, okay? But they don't bring that number up just because the company gets better, right? So the balance sheet value, the book value of Apple is greatly understated, and we could come up with our own value if we wanted to by thinking about how much it would cost us to create a company that's as well known and works as well and is as well loved as Apple. And that's just a thing to think about. Okay, so liabilities, right? We'll see. They have bills to pay of 55 billion. Other things that'll come due this year of 48 billion. And then when we add all that up, okay, for current liabilities due within a year, 125 billion. Okay, and now this is the part that's going to make a big difference too. Okay, they have term debt, right? Like the bonds we're looking at of 110 billion. Okay, and total liabilities are 287. Total assets were 351. That's a good sign. So in the case of a profitable company, if we just shut everything down, that's an amount that they'd have left over. If we ever talk about more indebted companies, then we'll start to push back on some of the assumptions that underlie what it says on the balance sheet. Okay, but we don't need to do that as much here because we can count on the fact that I'm skipping the statement of shareholder equity, forgive me, and I'm going to skip over cash flows for a second, just to go to the income statement or the statement of operations, because when you have a profitable company, you can look to the profits of the company to pay you back. So we see that they sold $367 billion worth of stuff and provided, I'm sorry, they've $300 billion worth of stuff, okay, and 68 billion of services. This is what it costs them to do all that. This is what it costs to run the headquarters. That's SG&A, and then developing new products. So that's what it costs. And Apple is operating income, paid taxes, and then so they had net income of $95 billion. So for a profitable company, you're going to look not only to the assets, but also to their ability to earn income, okay, to determine whether or not they're likely to pay your bond back. So I hope that we agree that it's pretty likely that Apple's going to pay us back if they ask to borrow the money, okay? So anyhow, interest rates have risen, so the price of our bond has fallen. So if we want to get paid back in May of 2023, we can buy that Apple bond. Bonds are not the world's greatest investment, especially when interest rates are low, because all you're ever going to make if you hold this bond to maturity, right, is 1.4%. Now, maybe you want to earn 1.4%, and maybe it's better than holding cash in the bank. The problem is there's a lot more that can go wrong than can go right. So aside from some specific circumstances that I don't want to get into too much because you'll know if you really want bond interest, what I'm going to say is that for the individual investor, you don't need to own bonds, especially in the low interest rate environment, unless and until you're going to get an equity-like payoff or better, okay? So I want to give an example of where I think that is the case today. I'll go back here and search. All right, so AMC Entertainment is the largest operator of movie theaters in the United States. It's been in the news, quite a bit over the last couple of years because some interesting things have happened in their stock. I want to show an example of some interesting things that can happen to AMC's bonds, right? So I searched for AMC, I sorted by maturity, okay? And then I'm going to pick this one here. This is a 2025 bond, okay, for 79 cents on the dollar, right? So we're going to see here that the history of this bond is really, really interesting. At the bottom of the COVID, stock market panic, you could have bought this for $5, and today it's almost at $80, or rather 5 cents on the dollar, and now it's at 80. And I believe for for reasons we're going to discuss, that it's actually going to get paid back at par. So what does that do for you? Okay, you can buy this bond at 80 cents on the dollar, 79.25. So for a $1,000 bond, you're going to pay $792.50. Okay, and then you're going to earn a coupon of 5.75 on the whole $1,000, right? So that's $57, and that'd be 5.7% on 1,000, but you didn't pay 1,000, you only paid $792. So what does it mean? We talked about what it means to be owed money by Apple, and that seems like a pretty good deal. But what does it mean to be owed money by a more highly indebted company like AMC? So I'm going to go back and look at the company filings and financial statements. Okay, they published an annual report on March 1st, and we will look for that statement of income or statement of operations. I'm just searching to see net income. Okay. Oh, this is just telling us that they don't have any, and it's mentioned throughout. So the term I searched for before was cash and cash equivalents to find the balance sheet information. All the financial statements will be together. Okay, so same deal here, right? So the first thing to point out, okay, let's go back to that statement of operations. Sometimes it's called an income statement. So for the year ending 2021, okay, they had a net loss of $1.27 billion. That number represents some different things, but it was a lot better than in 2020 when most of the theaters were closed and they lost 4.6 billion. Okay, in the last whole year before COVID happened, they lost $149 million. Okay, so one of the biggest questions in the stock market today is, as things continue to improve and open up, is that $1.2 billion loss going to look more like that $149 million loss from before COVID, or will it be even better than that? So that's a big question. And answering it, if we think the company is going to become profitable, then you should definitely buy AMC bonds. But what we're really interested in is is maybe those bonds can be a good deal even if the company doesn't become profitable. And that's where I'm headed with this. So if we look at AMC's balance sheet, they have almost 1.6 billion in cash, okay, on the balance sheet as of the end of the year, right? Whereas the year before they only had 308 million, okay. And then I'm going to skip down and look at corporate borrowings. 5.4 billion right now, and that used to be at 5.7. Okay, so that'll show up in, okay, normally the book value, we would say the company's equity, but here they're in deficit. So they used to have a deficit of 2.8 billion, and now they have a deficit of 1.8 billion. So that's headed in the right direction for repaying these bonds. A more detailed discussion would go through step by step the cash flow analysis, and here's the kinds of things we're going to look at. We said that they lost $1.27 billion, okay, but not all of that loss is really money out the door. So in a cash flow statement, we can add back depreciation and amortization, which means there's things that they own and things that they buy that become less valuable over time, and you take an accounting charge for that. Well, is that depreciation real? Well, what we can do is go and look at capital expenditures. So they said that they lost $400 million of things that depreciated, okay? But they don't need to spend $400 million to replace stuff. In fact, it was 92 million this year, 173 last year, and 518 the year before. So if the real capex that they need is 518, then that 425 is a very real number. Instead, if the capital expenditures they need to keep up are only 92 million, then they're doing pretty good. And this net loss is too high with respect to the amount of cash that they're going to have to pay out for things. Okay, so I'm going to go back up to the income statement and make one other point real fast. Right, we are talking about all the money they owe, and one of the ways to see what they need to do for that money is to talk about the interest expense. So you see, before when they borrowed $5 billion, they used to pay 292 million in interest. And this year, it's I'm sorry, year 2021, it's 415. Okay, so now I'm going to look at their long-term debt in one chart here, which the company has to publish, and explain to you what kind of money they owe and what that looks like. All right, just a second. Yeah, here we go. Note 8, corporate borrowings. Okay, the first thing to note is that they're grouped by lien priority. Okay, so secured debt and first lien secured debt means that these lenders, okay, in these amounts here, have the right to come and take stuff ahead of everybody else if the company goes bankrupt. Okay, these second lien lenders also get to take stuff, but they don't get to take anything until the first lien lenders all get paid. Okay, here they've called the bonds that we're going to look at subordinated. Subordinated means that one bond is higher or lower in priority than another. These are really unsecured bonds. Sometimes they get called senior bonds, and that doesn't mean anything either. So I'm just going to refer to them as unsecured. Okay, so the way to describe this is to say that, first of all, the first lien secured debt, okay, going through to this number, right, we can just add that up quickly. So it's going to be, 1.95, 5.52, we're at 2.4, 2.9, okay, a little bit over 3, 3 and a bit. Okay, then that second lien is 1.5 billion, right? And then these small unsecured bonds are actually pretty small in amount. Okay, so the 5.75 we're looking at, there's 100 million of it outstanding, right? But look at all of this stuff before here. 3.3, 3.2 billion of first lien secured, 1.5 billion of second lien secured, and then another 300 million of these unsecureds. So there are, if push comes to shove, many, many people who have to get paid back first at a high rate of interest. Okay. Now, the next thing to note is that second lien bond has a 10% interest payment, okay, and that can go up to 12 in a PIK toggle situation. PIK stands for payable in kind. That means that if the company doesn't have the money to pay or doesn't want to pay, that they can actually just increase the total amount that they're indebted. Imagine like having credit card debt and then taking out another credit card that itself would accrue interest to pay off some of that credit card debt. So the amount that they owe can theoretically go up. So you see, when they took out that second lien loan, it was 1.4 billion, and now it's 1.5, and that's because they took the PIK, the payable in kind option. They've said they're not going to do that anymore. So there are a lot of people that have to get paid before the unsecured bonds that we're looking at, okay? And those second lien secured bonds, which have the right to take specific property if the company doesn't pay them, have to yield at least 10%. So what that means about our unsecured debt is that it has to yield more than 10%. And the reason is the same as because same reason that the interest rate on a credit card is going to be higher than the more interest rate on a mortgage. Okay, so when we come back and look at that AMC bond that I like, what can we do if the bond was issued at 5.75 and I said that it needs to be at more than 10%? So the bond price gets pushed down. Okay, so in this chart over the last year, you can see that it got as low as 63 cents on the dollar, and now it's at 77. So the way that the yield on this bond gets calculated, this last trade yield will capture both the interest rate to be paid, and then when you buy this bond at a discount but get it back, get repaid at maturity as a premium in 3 years, okay, we can roughly, just for off the top of the head math, say, oh, all right, there's 21 cents of value, okay? It's going to get repaid to me 3 years from now, so I'll divide it by 3. So then we can add 21 divided by 3 equals 7, okay, on top of the coupon of 5.75. And now we're talking about 12.75. This last trade yield number is going to have a little more math in it than that. For a quick and dirty explanation, it's close enough to say, we see how we got to 13 because we divided the premium by the number of years and added the coupon rate. For a longer duration bond, that's going to make a bigger difference. Okay, so why do I think the company is going to pay us back, and what would make this a good idea? So back to the financial statements for AMC. Okay, what we see here is that that first lien debt, this big number up here, okay, is a senior secured credit facility term loan due in 2026. That's at a low interest rate, and you can see that they've been able to borrow a lot of money and pay it off some other debt instruments that were more expensive. So they have some 2029 bonds that they were just able to borrow, and we're going to see here, okay, that they were able to borrow another $950 million, okay, at a lower interest rate. And what that does, if we go back and compare to the rates that are listed here, they borrowed another 900 million at 7%. So what can they do? They can start to pay off higher interest rate debt, like this one is 1075, okay, and 7 is lower than 1075, right? And then they can also pay off bonds that are due sooner in time, right? So let's find another one, okay? This one may be out by now. So they had a 10.5% note that's due in 2026. Well, the new bond that was issued after the time described in that financial statement, you're going to see, first of all, it's not going to be due until 2029. Isn't that in here someplace? Right, and so their goal was to pay off that 10.5% debt. So they have longer to pay this new money back, and they're going to have a lower interest rate. So lower interest rates mean less money coming out of the company over time, meaning that they'll be more likely to repay money that they actually owe. If we went through this process, I think they're going to continue borrowing cheaper and paying off that higher interest debt. So even if they don't return to profitability, we're still going to get to the point that they're able to borrow money at reasonable rates and pay off this 2025 bond. So anyhow, I hope this has been a description that's interesting and useful about why corporate bonds can be a good investment. In this case, even though I don't think AMC is going to be profitable anytime soon, basically the market's going to keep giving them money to borrow more and more cheaply, and that credit rating is going to improve. The amount of time left is going to get smaller and smaller. And then this is another really interesting feature of discount buying corporate bonds at a discount. Okay, if you bought this bond today, you'll be paid $1,000, but you've only paid $792 for it according to this price. Well, if you held it for a year, you're going to get that $57 in interest. So what happens is at the end of a year, you've received $57 in interest payments, okay, but you had $792 invested. So 792 minus 57 means the whole investment a year from now that you have waiting on AMC is actually only $735. And then if we do it again and take out another 57, 2 years from now, you're only going to have $678 at risk. And then one more time gets us down to 621. So 3 years from now, all the money that you'll have at risk in AMC per bond is $621, but they still have to pay you back the $1,000. So 3 years from now, you've received a bunch of your money back, and then we say, okay, 1,000 minus 620 means 380. So a $380 payoff on $620 at risk means 3 years from now, you're actually going to get a 60% return on the money that you still have invested in that bond. So it actually becomes a higher returning investment the longer you hold it and the closer you get to maturity, and more of what you paid comes back along the way in coupon payments. You can go buy anything else that you want to with that. Anyhow, there's a lot more detail to expand on. I think it's a really neat topic. There are not a lot of bonds trading at big discounts in the market today. I think this is a really unusual one, and it's a great complement depending on your risk profile and your cash needs and all those kinds of things. It can be a really good complement to an equities portfolio, especially where we're talking about more than 12 or 13% a year. I'm happy to answer any questions. I look forward to being in touch with folks, and thanks for paying attention. Good luck, Adam Block, MVP Long Short. I look forward to being in touch.